Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Seiwan, Professor of Economics at Ewha Womans University. Professor Kim, good afternoon and thank you for coming on.
Good afternoon, Devin.
Well, the Bank of Korea, as we just heard, has decided to keep its key interest rate where it is at 0.5%. It's also lowered its GDP growth forecast for this year. Tell us about today's meeting at the BOK.
It looks that keeping interest rates steady at 0.5% level would be the only choice for Bank of Korea as of now, because Bank of Korea faces pressure from both interest increase factors and interest decrease factors. The pandemic resurges and real economic activity is still sluggish, so it doesn't allow increase the key interest rate by Bank of Korea. On the other hand, decreasing rate is not feasible either, because lower interest rate generates more bubbles in housing market and the possibility of funds outflow from domestic market for smaller interest gap against the United States.
Well, now, Professor, there are concerns about Korea's future economic growth now that total fertility rate has fallen to the lowest level on record. What's your view of this issue?
Yes, this is a really serious problem, David, in the long run. These days, we are stuck in concerns on COVID-19's shock to our society and economy, but real concern in the long run, like in 100 years, is declining population and aging demographic structure. According to Statistics Office of Government, last year's total fertility rate, which is the average female's total number of childbirth for life, is 0.92, and this is the lowest level between 36 OECD member countries. This situation is particularly serious in rural areas far away from metropolitan area, and if that situation continues, quite a few rural districts will be disappeared in the next century.
Now, switching gears here, we have central bankers, economists from around the world getting ready to meet at Jackson Hole, Wyoming, or they would be, but this year it's going to be held virtually. Jerome Powell, the Fed chairman, to give a highly anticipated speech there. What should we be watching for?
A big attention is paid at Mr. Powell's speech tonight at Jackson Hole meeting, because in the meeting he can suggest new Federal Reserve policy target in for continuing his expansionary monetary policy. He can suggest maybe average inflation target, which makes U.S. Federal Reserve implement more aggressive and longer expansionary monetary policy. So if he really pay attention on this new inflation target, that could affect other central banks' monetary policies too.
Yeah, we'll have to talk about that next time once we hear what he says. Now, stocks in New York are up again, and by quite a bit. The S&P and the NASDAQ at new highs. What's the story in the global markets?
There were 5 straight trading day rise in U.S. market until yesterday. These positive returns are mostly due to high-tech stocks' great performances. Dow Jones Industrial had 0.3% return, and NASDAQ had 1.7% return yesterday. Along with U.S. market, Euro markets in London, Paris, and Frankfurt also had positive returns, but Asian markets had negative returns today in Tokyo and Hong Kong, as market participants are maintaining a wait-and-see attitude before Fed Chairman Powell's speech at Jackson Hole meeting.
It seems that was the case here in Korea today, too. The Kospi and the Kosdaq both lower. Is that the fear of the lockdown in Korea, or what was driving that trade?
Domestic market decreased for today in both Kospi and Kosdaq markets. Rising concerns on pandemic resurgence these days has blocked U.S. market's positive impact on domestic market. Kospi had negative 1.1% return, and coal stock had negative 0.6% return today. In both markets, as usual, domestic individual investors bought stocks, but foreign investors and domestic institutional investors sold stocks.
All right, Professor, we'll have to leave it there for today. Thanks so much for coming on. We'll talk again soon.
Thank you very much.